Are real estate taxes deductible? Every year, millions and millions of homeowners here in the United States pay thousands, tens of thousands, hundreds of thousands in property taxes. And there's a simple question is, are they deductible? So I'm going to break down the truth for you today about what real estate taxes are deductible, how to do this, what you should know about it, and how you can put more money in your pocket by not paying as much in property taxes. First off, let's just go through the elephant in the room, the SALT deduction cap. And you go, what is SALT? SALT is your state and local taxes. And back in 2017, Congress put together a $10,000 limit on that deduction. If you're married filing separately, that's as little as $5,000. And that can feel like a gut punch in some of these crazy high-tax states. But there's really a huge catch to all this. Not every homeowner can benefit from this because you have to itemize your deductions. And so some of them, the standard deductions, may already be more. So let's get into the details. To be eligible to claim a property tax deduction, you have to have two things. One, you have to own a property. Two, you have to itemize your deductions. The standard deductions for a single individual are $13,850 and $27,700 for a married couple. So if your deductions aren't more than that in aggregate, it's probably not worth even bothering to itemize them. Just because you can deduct something doesn't mean you should. And for most of you, you're gonna go try to file a TurboTax or one of these cheap things. I would argue with every single one of you, get an accountant. Talk to the professionals. Accountants have saved me hundreds and hundreds of thousands of dollars in taxes. Don't do them yourself. See, the IRS weaponizes taxes against you, and property taxes is one of those things. There are also non-deductible charges. What? Say what? There are charges inside of your tax bill that the IRS says are completely non-deductible. They are things that are service fees for local municipalities, local benefits like sidewalks or sewers or impact fees, or utility fees levied against you, and transfer taxes on the sale of property. The IRS says, these are not deductible. Of course, talk to your accountant in regards to this. The IRS defines this rule pretty crystal clear. If it doesn't impact the value of the property, it is a no-go for deductions. When you have a question, talk to your accountant. And for those of you that hang out with us all the time, all of our subscribers, thank you for being a part of this. Hit the like button if you're finding this valuable, because we want to help you understand real estate and the making money and the keeping of money in real estate. That's our game. Now, of course, with the government, there are always special considerations, and these can vary state by state. So I just wanted to give you an example. In California, there is the Melrose tax, and that tax is always there to fund local infrastructure and projects. That is not tax deductible. So when you look at your tax bill, you got to break down what's actually tax and what's other fees that are levied on that are not deductible. Given how much SALT, the state and local taxes, impacts homeowners, it's no wonder that during the Trump presidency, this has kind of created a buzz, because he's going to go through, most likely, and work on increasing those deductions, which is going to help you, our listeners, to put more money in your pocket. So right now, there's no better time to understand these deductions. But Anton, what if I already have a super high tax bill? What can I do? Well, I love that you asked that question. Here's how you deal with it. Every year, you're going to get your tax bill from, generally speaking, the county assessor or the local city. The county assessor generally creates some type of value based on the square footage, the improvements, breaks part of it out for land and part of it out for the structure. We need you to go through and we need you to review that for discrepancies, things that are incorrect, and then look at the value of both the structure and the land separately. And I want you to ask this question: do these numbers seem reasonable for the market that I live in? And if they don't seem reasonable, then you need to go challenge it. At the bottom or sometimes on the back of your new tax assessment statement. And they usually come out once a year, twice a year, or sometimes quarterly. You flip it over or you look at the bottom, it will say on there, and it's always in small print, by when you have to submit a request to fight it, to disapprove it, to provide another valuation. What I want you to do is I want you to then either go do the research yourself if you're super handy. You could go to Redfin, you could go to Zillow, you could go to Craigslist, you can go to your tax records. You need to find comparable sales. So if yours is a 2,500 square foot home on a quarter acre, you're going to find a 2,500 square foot home on a quarter acre. And if all the ones you find are selling at $550 and they're trying to tax assess you for $750, you have a great case. Now, if you're not comfortable doing that, then you need to go to one of the next two routes. You either are going to need to pay for an appraisal, or you're going to need to go to a real estate broker and ask for a broker price opinion to help demonstrate the value and the comps. You put together a written narrative with 1 to 6 comparables inside of it, demonstrating how the assessor is overcharging you based on what's selling in the market. The worst one I've ever had, I got a tax assessed statement for $2.6 million for a property in Lake Stevens. I about blew a gasket because this was over $27,000 a year in taxes. So I very quickly went to the bottom. I figured out the date, and they usually only give you between 30 days to 90 days to respond. So you kind of have to be paying attention to this. We then went and put together all the comparables. We justified our case. We showed it to them. We were able to get it reduced to the correct market value. And the correct market value was about, let's call it $1 million. We were able to get the tax assessed value reduced to $820,000. So instead of paying over $27,000 in taxes, we ended up paying about $8,600 in taxes. Was that worth the time to go do the research and make it happen? It absolutely was. This is why I'm educating you on how to do this. See, we're not telling you anything in the game that we're not playing, that we're not helping our investors do, that we're not helping our other homeowners already do. Also, most of them, if you miss the deadline, do have an exception for a hardship if for some reason you miss something like that. But it's going to have to be major. It's going to have to be medical. It's going to have to be a family emergency, job, something of that nature. It can't be, I forgot. Because yes, even with all the ones I challenge, and I make it a sport to challenge these every year, I get denied on a regular basis. It's okay. You should just ask. So the bottom line, 1, real estate taxes are deductible. 2, not everything on your tax statement may be deductible. 3, you need to make sure it's worth deducting it because your deductions exceed the itemized deductions on your tax return. Talk to a professional. 4, when you get your tax assessment, you should review it, identify it, look for problems, and probably fight it if you believe it has been too high. So hopefully that's going to help you crush your property tax assessment value, save you tens of thousands of dollars. If this has been helpful, if you can just simply hit that like button, hit subscribe. If you have any questions, drop them in the comments below, and we're happy to chat more.